you're an investor, should you time the markets? Well, here's the thing, if you're an investor and you are trying to forecast or time the markets, it kind of defeats the purpose, because I would say nature of investing is to weather out market fluctuations and build your capital by compounding interest, as opposed to traders or speculators or gamblers who are making money due to the market fluctuations. Thus, their ability to move in and out of markets are essential to their success, or on the surface it might seem so. So the answer probably is, not probably, but is flat no. No, you shouldn't time markets or try to pick best time to invest if you are an investor. Well, here are a couple of things for doing so. Firstly, it's impossible to do that. What is impossible? It's impossible to correctly time the markets. There hadn't been a single successful investor who has been making money based on timely forecasts. Well, someone might be lucky enough at some point to enter or exit the market at just the right time. Yes, of course, it happens from time to time, but in general, there is no reliable system or proven system that could do that, because if there would be, everyone will be using it and it will be cancelled out by market participants. So there's another thing. But most importantly, it's actually not that necessary, because I cannot recall precise research, but there was a research done for like last 80 years or something like that, when there were two different approaches. One was to simply invest in index funds, and second was to invest at the best times. And no, I would rephrase that. The best, that would be to invest at the lowest point and to sell at highest point, so to do perfect market timing. And actually that difference in cumulative returns was like 2%. One was like 8 or 9%, other was like 2% higher. Now, if in compounded interest metrics, it's a lot when you compound it for 80 years, but in practice, it's not that large, because we have been talking about cherry-picked results who are so good that they are not possible to replicate in real life. And it shows actually the point that you don't have to spend that much time and energy for so little additional gain, which is impossible to achieve anyhow. You will be far better off by simply trying to use your risk management and overall portfolio management techniques, how you could improve your overall asset allocation. That's the more important thing than timing. The more important thing is to have the best strategy for your own portfolio, namely how much money do you have and how much you allocate in certain assets, and how you play those cards right, rather than to try to know whether this is a bad or good time for you to invest or sell your investments on stocks. That's the fundamental difference. And in fact, I could give you one additional practical example for avoidance of timing markets, because as I recall, one of the best fund managers ever who relied his strategies on value investing was Peter Lynch. And he always had money into markets, always. He had very little cash around him. And same was to Warren Buffett and Berkshire Hathaway. Their philosophy always was that they have to be always invested, and only not few, but little percentage of their assets will be allocated in cash and cash equivalents. Why? Because in general, markets tend to rise. As I have told in my previous videos, S&P 500, simple S&P 500 within itself is an investment strategy, which is not that bad. And by rules of probability, it will rise. You never know when and how, but in general, it will rise. So probabilities are you will be always better than if you are invested in markets, even if you have a rough quarter or even couple of years, than if you are simply standing on your cash and doing nothing. That's paradox. Yes, that might be some valid reasons behind strategies when you have to hold only into cash and then go aggressively to certain investments. But that's a bit different story. We are talking here more about classical portfolio investing for your asset growth. We are not talking about business or some speculative activities. That's a different story. It might be part of your overall business model or investment model, but here I am just covering the phase where you invest in mutual funds, index funds, or ETFs or things like that. In there, you're much better off if you're consistently investing. And of course, there are countless of strategies that shows that if you use blunt tools such as index investing and dollar cost average, you will be better off than timing the markets. Not only, well, I'm kind of rephrasing what I previously said, but here's a different thing that I previously thought. If you are even actually able to do that, you'll be only better off if you're able to forecast markets than you are, but then you are if you're doing nothing. But if you don't know how to forecast markets, you will be much better, much worse if you are not investing in index funds and doing nothing. That's the thing. Numbers say, probabilities say, and everything says that you should have to invest markets into index funds, but do that in correct way, whether it's dollar cost averaging or simply hold certain percentage of your assets into stocks. Well, that is up to each investor, but you are better off if you do that and let compounding interest and probabilities do their magic and grow your capital. And of course, equally as important, it would be much less stressful than to try to time out the markets, because then you start to trade, then you start to burn out, try to pick best markets or worst markets, try to fit data which would support your narratives and do other silly things which are not very healthy to do that. Now, if you're a retail investor and now you are starting to doubt your ability, worry not, because institutional investors, I would say, are actually more prone to these things because they have much more stresses, because not only they have to perform well to their investors, they also have to look good on comparison to their peers. So they tend to do everything what makes them popular, what makes them influential and sellable, not what makes them profitable. And this is not, in most cases, I would say this is not the same thing. So you are not only on who is in stress in this industry, everyone here is stressed. And best thing is, I would say, is to find approach which could calm you down and not think about markets that much. And of course, if you have like conservative stock investing strategy, conservative and profitable way how you choose ETFs, or you simply are following index funds, that's better. That's better in long term, simply just to allocate slowly money into stocks or index funds or good ETFs and wait for money to accumulate. Don't try to pick the best markets or worst markets. Don't try to time them. Don't try to put in and out your money out of the markets, because eventually at long term you'll be worse off, because we don't know how to forecast as humans. And as I told you about the third time in the beginning of video, even if we do know how to forecast, it actually don't matter that much as you might seem, because it's not most important thing in investing. Now, it might seem so, but trust me, it's not the case. So facts are quite obvious, and it's only your ability to stick to that plan and your self-discipline to pull it off. Because if you have started to invest in like 2021 and now markets have fallen quite a bit, now it might be challenging, but I would say, I don't know nothing about next year, but in 5 to 10 years period, on average, you will be better off if you have invested into stock markets to find some good stock investing strategy, rather than you will be simply holding your money into cash. That's the fact. And I advise you to do that. And if you want to see more content, make sure you are following me. And till next video, bye.